Hello and welcome. Joining us today is Ashish Naik, Fund Manager at Axis Mutual Funds. In this conversation, we'll explore his strategies for navigating today's volatile landscape and building resilient portfolios. Welcome, Ashish.
Thank you so much.
So, Ashish, starting off, we're in a market where valuations across large, mid, and small cap segments are stretched. So, how are you approaching equity allocation in such an environment?
Absolutely. Great question. So, yes, I mean, obviously, valuations have been remained stretched. And in fact, we have seen valuations across the board expanding over the last few years. Primarily a function of also the fact that we are coming out of COVID. Since the last 2, 3 years, we have seen earnings expansions across the market. There have been a lot of inflows that have been consistently coming from the domestic side, something which was probably not the scenario maybe in the last decade. Uh, Both of these put together, what we have seen is while large caps today probably are nearer to, let's say, 5-year average levels post the corrections we have seen in the last 12 months. And mid and small caps still remain at a much higher premium, even in the last 5 years. And in fact, overall market over, let's say, a longer term period seems to be at a premium. So, yes, there is some bit of higher valuations. One needs to be cautious of this. And to that extent, we have reduced for example, wherever we have equity allocation across various asset classes, the equity mix in the overall asset mix has come down, maybe by a range of 10% on an average in the hybrid funds. Even in some of the other funds, there is a slightly higher level of cash, or for that matter, the mix from, let's say, mid and small caps. Wherever possible, we have increased some bit of higher exposure to large caps in most of the funds.
So, Ashish, the global macro backdrop is shifting rapidly, whether it's a Fed policy, geopolitical tension, or the supply chain disruptions. What are the biggest external risks you are watching right now?
Absolutely. So yes, I mean global backdrop has remained volatile, not just in the last few months, but actually for the last 2, 3 years, as we started seeing geopolitical imbalances, geopolitical tensions in the form of actual regional wars across many parts of the world, and that has continued even the last few months. And obviously, as a country, we have also faced some of those issues. Um, to that extent, there have been market movements and volatility, which has increased. Also impacted by the fact that we are dependent on commodities as a big importer. But overall, things have not been that volatile or that difficult for us to navigate, given that the overall macro for the country has remained relatively stable. The inflation rate in India still seems to be under a decent level and in the range that the central bank wants. But what is also important to note is that the tariff war, which is another sort of a geopolitical tension that has manifested in the last few months, seems to be a much bigger issue. And that is kind of all encompassing, where every country is sort of getting into tariff related negotiations, tariff related talks. As long as these kind of unwind and sort of come back to normalcy, it should not be a big issue. But if at all these kind of blow up and are not able to get mitigated, that can result in lower growth across the world. And because of the lower growth in the global scenario, some of our sectors will also be impacted. And in general, that actually will also have an impact on our currency. In terms of, let's say, if we were to look at central bank policies, we were looking at inflation sort of tapering down post the higher inflation that we saw in the last 2, 3 years. But even that seems to have come for a pause, especially from some of the larger central banks like the Fed, where now the eye is on the impact of tariff wars. Having said that, in case there is a low bigger impact on growth, that will become a priority at some point of time for central banks, and to that extent, we remain watchful.
Ashish, do you expect the earnings growth across Nifty or the broader markets to justify the current valuations or the market running ahead of the fundamentals at this point of time?
Absolutely. So valuations, as we just discussed a couple of questions back, have remained higher and have expanded across most cases. To some extent, that is justified, and there are also some sectors where valuations still seem reasonable, and probably one can look at those. But overall, what is more important now is that we start looking at absolute valuations for companies. versus what they deserved and what they sort of were trading at, compared to the growth that they can generate. So absolute valuations of a company, if the growth rate starts to sort of moderate, they are not able to meet, even if that is a higher level versus, let's say, their past. So for instance, a company which was growing at 15% is growing at 30-35%, and the valuations have expanded. Even if it comes down to 20-25%, the valuations of that company can come under stress. This is also given the fact that we are seeing that while the inflows have sort of continued, we are also seeing outflows in the form of various kind of issuances by companies, IPOs, etc. So to that extent, we are slowly getting into a scenario where overall market flows are balanced, and hence now it becomes more important to be selective and be aware of valuations. And if there are excesses, one needs to sort of take actions in the portfolio.
Ashish, could you please share your investment philosophy and how you pick stocks for the portfolios?
Sure. So as you know, since our inception in the last 15, 16 years, Axis has always been known as a growth and quality based fund house. Those remain the key pillars for our investment philosophy. We always look at companies and try to find companies and managements that can sustainably grow over a longer period of time with sustainable cash flows, high ROEs, and hence relatively they can navigate the cyclical movements in the economy better. Having said that, one can always say that the overall market scenario, overall economic scenario has changed versus, let's say, the last decade to now. We are now seeing many new sectors, especially the investment part of the economy, as it has started to start growing, started to show green shoots. Various sectors and subsectors have come under what we call as the traditional definition of growth quality. There are companies that can sustainably give us growth from a medium-term perspective, and also the cash flows there are starting to improve. Given that scenario, what I would say is yes, our philosophy does remain growth and quality, but the definition also includes many new companies and sectors. And to that extent, we are looking at and have made changes in our portfolios.
If you look at the Axis ELSS fund, it has moved from the fourth quartile to the second quartile in the last 1 year. What are the key drivers that contributed to the sharp turnaround of this fund?
Sure, John. So yes, I mean, in the ELSS fund, this is, the changes in this fund have been ongoing, especially for the last 2 years that I have been there with it. The earlier things that we were doing and what has really helped this fund from a long-term perspective has been the bigger holdings that were there, which are probably slightly more concentrated. So to that extent, we have reduced concentration in some of the bigger names. That has given us space to add. And as I mentioned, there have been many new sectors and subsectors which can kind of contribute to the economy as well as in terms of returns to the portfolio. So we have diversified the portfolio in terms of sectors. Also, what is important is that because there are relatively more positions which are not very big, it has made the fund much more agile to take market realities. And as we know, market today in terms of cycles is shifting at a very fast pace. There are sectors which do well for a few months or a few quarters and then again go under a downturn. So we need to be also more agile. So these are the changes that we have done. Overall, the growth and quality tilt of the fund still continues, but obviously, as I said, it is much more broad-based in nature.
Do you view this recovery as a function of market tailwinds, or were there deliberate changes made at the portfolio level?
So I would not attribute anything specifically just to growth or quality or something specific. Market, as I mentioned, has been moving dynamically for the last few years because of the global events, because of the fact that there are many new sectors domestically that are doing well. So having said that, obviously during corrections, relatively stable companies do tend to outperform more cyclical names. And as our fund does have a tilt of those kind of companies, there is some help that it does. But we are also, as I said, being much more broad based. We are also being much more agile as a fund and as a fund house.
So, the rebound in quality and growth-oriented stocks seems to have helped many exit schemes.
Mhm.
How significant was this factor for your portfolio?
So it has, something that does really help. And if at all growth quality does well, as that is something that we also have slightly higher tilt in our portfolios, it does help. But having said that, being nimble to market reality, being diversified in nature, and also what is more important is stock selection. So when you're selective, when you're aware of, let's say, what's happening in the individual stocks, in the individual portfolios, one can actually take better calls. And we have done that. We have been much more selective while we are broad based, and to that extent, funds have been helped by that also. And yes, as I said, stable companies do tend to outperform when there is more volatile environment in the economy.
Ashish, could you share with us a couple of stock calls or sector tilts that has worked well recently and the rationale behind those calls?
So yes, I mean, sector calls, as I said, being having more sectors, have, probably the parts of the investment part of the economy, capital goods, etc., are something that have really worked well for the fund. And to that extent, there are various subsectors which were probably non-existent as investable ideas, as long-term nature ideas. Things like defense, things like anything related to power, maybe T&D, things, even traditional sectors like pharma, CDMO, for instance. All of these sectors, over a time, as the economic scenario and economic realities are changing, have been able to outperform quite well. Some of those sectors and some of companies in those sectors we have been early to have in across our various funds, and that has really helped. Uh, but at the end of the day, what is important is to understand that it is not going to be a top-down approach. It is not necessarily, except probably funds like the business cycles fund, which will always work from a top-down or a macro-driven approach. It is important to catch the companies, catch the right kind of management, right kind of fundamentals at the right time, and then hence be able to grow with them, which can result in better returns over a longer term.
Have you made any conscious changes to the sector allocation or stock selections for the past 12 to 18 months?
So it is obviously the fact that in let's say if you compare versus last decade to maybe post-COVID or this decade, we have seen that the nature of the economy itself is growing and is diversifying. While the most portion of the growth that the economy was able to do in the last decade was probably services slash consumer-driven sectors, and those are the sectors which were also represented in our portfolios. Maybe that resulted in some level of concentration, but today we are seeing that the traditional cyclical sectors, capital goods, or for that matter, newer sectors, new age companies, sectors which were probably much smaller earlier in the whole, CDMO space, in the whole many more subsectors when you go to capital goods like defense, like railways. All those sectors were not existent or not as big to sort of take positions in the fund, probably not seeing very high growth. So these are the things that have added in terms of what one can have in the portfolios today, which have become investable ideas and that are contributing to the portfolio.
Ashish, Axis Mutual Fund faced a rough patch over the last few years, especially with growth quality strategies underperforming. What internal reflections or strategy recalibrations took place during that period?
So yeah, I mean, yes, growth quality was a philosophy or was a strategy that outperformed for a very long period of time, especially since we started this fund. I remember most of the period in the last decade, growth quality was outperforming. Obviously, these kind of strategies also go through their cyclical turns, where the let's say the more cyclical names, or probably the less high beta names, if I have to put it in perspective, tend to outperform for a certain period of time. It is probably driven by the fact that market has gone through a downturn, and in the recovery, these relatively more cyclical names tend to outperform, and that is what we saw sort of happening. At the same time, there were also market realities, and we as we were okay to some extent, where cyclicals are outperforming and some part of our portfolios will not show that level of high returns. But obviously, what we also needed to deliberate, and which is where I keep coming back to the fact that if the economic realities were changing, if there were newer sectors and newer companies in those sectors that are doing well, and their outlook is improving from a medium-term perspective, they need to be represented in the portfolio. So those are the things that we have done. Probably done much faster in some of our smaller funds, because obviously the liquidity was never a constraint. In the some of the larger funds, these changes have happened over a gradual period of time.
Do you believe the Axis MF has turned a corner in terms of investors' perception and the performance credibility?
I think one thing that, because I have been with Axis since inception, I have always, whenever we have visited distributors, various industry participants like yourself, and also even individual in larger gatherings, what we have always seen is they look at Axis as a fund house which has stuck to what it has done best in terms of sticking to the growth quality philosophy, in terms of being able to be ahead and kind of find uh, investable ideas that probably are differentiating their portfolios, and not necessarily being someone who follows or does what is sort of called as a momentum strategy, for a better term to use. To that extent, they did realize, and they have always been cooperative in the fact that when we had great periods of outperformance, there will be some periods that there could be underperformance to some extent. Having said that, we also made sure that we are reassuring them that we are on top of the changes that need to be made. There is nothing that really fundamentally is changed in terms of how we work, and in fact, it has only gotten better with the changes that have come into the team. We have added new fund managers, we have increased our research coverage as well as the research team. In the market reality where the market is broad based, we also needed to sort of be make these changes. And once we had done that, when we went back to our investors and showed them the results of what we have made, they were more reassured in terms of what we are doing in our portfolios is in the best interest of the clients.
So, Ashish, your business cycle fund operates with a macro thematic lens, right?
Mhm.
So, how are you positioning it in the current high valuation, low margin of safety environment?
Great question. So yes, business cycles as a fund needs to be managed on the top-down market reality. That means we need to find sectors that can, sort of do well, especially if there is a cyclical upturn. For instance, one needs to add banks, real estate. If there is a downturn, one needs to sort of look at sectors which probably will do relatively better, like FMCG. So that would be the basic way of running a business cycle fund. What we did differently and what we have been doing differently for the last 2 years or that we are running this fund, if we are also looking at sector cycles, which means there are sectors which can do better in an economy like India, where without having macro backdrop also, just because the fundamentals of the sector are changing, it can do better. So what we've seen in defense, for instance, and I keep coming back to this sector because it has been having its own cycle, but there are so many others which are driven by manufacturing, EMS, for instance. We have seen many other sectors that have come up, new age economy, for instance. So all those sector cycles are also important to be looked at when we talk about business cycle. We have been able to do that, and hence what we have seen is that business cycles fund has had a mix of macro. Which is top down, as well as some bit of sector cycles, which I would not necessarily target as top down approach. But yes, it is also important to have those. Having said that, what is also important to understand is business cycles fund in this environment probably has also had some bit of struggle, and this is across the category you will see. Because when you talk about a business cycle fund or business cycle, we are talking about at least 2 to 3 years of higher growth that the business cycles is able to generate. But in this environment where so many things are changing so fast, we have seen some of the sector cycles actually move at a fast pace for a few months and then go back down again. So actually navigating such kind of cycles has become difficult. We have one thing that we have done in the business cycle fund is not take very high sector calls of very big number in or in a very concentrated nature, because at that point of time we could have more volatility in the fund, and that has actually helped the fund navigate these volatile times relatively better. Over a period of time, we do expect that the business cycles fund will take much more sharper calls as we have taken in the past. At one point of time, this fund was heavily underweight on banks, for instance, when it was launched. Today, we are almost equal weight. So there has been bigger calls taken, and we continue to do that. But at this point of time, it is not as sharp in terms of sector calls as it was in the past.
Ashish, could you elaborate more on the ELSS fund, on the outperformance of ELSS fund, and what are the key triggers which has led to the outperformance?
So yes, I mean, one can say that over a, let's say, three-year period or slightly more than that, the sector does seem to have had some underperformance. But if I look at the fund over a longer period of time since inception, for instance, it remains the best fund in its category. It has outperformed the benchmark by a margin. And I do think that people who have stayed invested in this fund over a longer period of time have enjoyed the benefit of the way that we have been able to sort of contribute by having the growth and quality philosophy, with our ability to be able to be ahead of market in terms of stock selections, being able to navigate volatility better. Because we have not seen very big volatility in the markets, we probably do not see the benefit of having a relatively stronger bottom-ups driven portfolio with a very high level of stability. But having said that, as I said, we are also not sitting on the fact that we have good companies and they will do well. We are also ensuring that wherever there are newer themes, newer sectors, newer companies, businesses emerging, we are also participating into those, be it in the large, mid, or small cap category, and to be able to generate alpha with that. So there is a consistent effort to generate active returns. We are not we are not a fund or a fund house that has followed the index or have very high matching with the portfolio. So the active portfolios remain strong, and we still have a diversified portfolio. So there is a mix of both. We have a team today which can cover a much bigger range of stocks, range of sectors. That has happened in the last 2 years, and that has really helped us to modify our portfolios as and when needed from the market perspective.
Across Axis Equity Fund, is there a coordinated house view guiding sectoral allocations, or do fund managers have the greater autonomy now compared to the earlier?
So I've been managing funds in Axis for slightly more than 9 years now, and I have seen various stages of how the team has evolved. What I can clearly say as a fund manager is I've always had autonomy to manage the funds, barring the fact that there are funds where I slowly started, picking up coverage, where probably there would have been some level of handholding, and over a period of time there is more and more autonomy. But having said that, the autonomy remains when it comes to the fund manager individually or on an individual fund level. It is not that we are all, there has been any top-down approach of saying that we will probably have these kind of sectors now more in the portfolio, etc. And you can see that in the returns, right? With various portfolios having different nature of exposures. There are obviously reasons why they have different nature of exposures. For instance, a value fund will have a different set of sectors and companies versus, let's say, a business cycle, or versus, let's say, manufacturing, versus a diversified portfolio like multi-cap, flexi-cap, etc. But also, what is important, and the new changes that we have done, is to have regular meetings, regular discussions. Maybe if we talk about hybrid funds, it is more of the asset allocation committee which discusses what level of asset allocation the fund managers want to have, and they can express what they feel is the right level, and it is obviously discussed, and the fund manager is able to give the rationale. On the other side, also we are seeing regular, oversights of, let's say, if there are higher level of concentration in a particular stock or a sector, which is also highlighted to the fund managers. To that extent, there is a sort of, what I would say, is more oversight rather than a lack of autonomy. This does really help, at times to have outside in perspective, even for the fund manager while they are managing the funds at an autonomous level.
Ashish, are there any themes or sectors where you're incrementally building exposure today despite the noise in the market? Could you walk us through the thesis?
A very difficult question to give anything forward oriented. What we can say is, yes, we have added a lot of subsectors and sectors in the recent fall, where we saw opportunity since September of the market peaks. There were recent corrections across many sectors where we still said that the underlying growth story continues, the underlying demand that is there in those sectors continues, be it power T&D, be it defense, be it even things like traditional sectors like pharma, CDMO, or for that matter, getting out of sectors or exiting or cutting our positions in autos or IT, adding banks, for instance. We have added a decent level of banks across portfolios, ELSS, business cycle, etc. So clearly, we have done those changes, and those are kind of reflecting the market reality. Given what we are into the global scenario, being slightly more cautious on export-oriented stories or global-oriented stories has been the call. So those things have happened. One thing that we have seen in the last 12 months is the domestic slowdown. And we have also seen consumption at rural level and even now urban has slowed down. It is reflected in some of the sectors and stock valuations. Probably, if those things recover, we are seeing a decent monsoon recovery. Those are the things that one can be watchful if there are any opportunities. But I would not say anything forward-looking to sort of be cautious on that front. But yes, I mean there are opportunities that one keeps looking at, and that is what is the job of us as investment professionals.
With innovation theme playing out in the multiple forms from AI to fintech to manufacturing tech, what's your definition of innovation in the stock selection of the innovation fund?
Great question. So the innovation fund that we run, and I can kind of run you through that. It is what we call as innovation is as a theme is anything that is sort of a change, based on R&D, technology, edge that companies, that businesses, that sectors are having, be it in product, the process, or let's say a service, which can result into a much higher growth and profitability in the medium to long term. So innovation can be very broad term, and it is kind of a wave that can change the nature of sectors and industries. Economies, for instance, can change. So things like, let's say, automation or AI can change the nature of manufacturing across the world. So these are huge changes that we're talking about. Things, the advances that are happening in medicine and health tech can change how human life can be perceived, and what is the meaning of productivity can change. We have seen the changes in fintech and the innovations that our country has been able to bring to in digital payments. All those things, sort of can be looked at waves, and any company and any sector that can ride that wave to get to higher growth and profitability in their business is a target for our innovation theme. So it necessarily does not mean that these companies are themselves doing AI or are themselves doing automation, or let's say things like data center, for instance, becomes an offshoot of AI, and anybody is able to sort of capitalize on that. It could be simply a company who is providing power backup to that, or for that instance, giving semiconductor-based chemicals for the chips that are going to be manufactured in data centers. Those are the things that also become part of the innovation theme. So it's a very, very big and high growth area where many companies can ride that. It's important to also understand that while a company can ride that wave, the wave can also destroy businesses, and hence be careful to not be part of these sort of businesses. So a bank can benefit from fintech and digital payments, and ride that. But on the other side, if they are not nimble enough to have the right kind of technology investments, they could also lose market share and edge versus their competitors. So one has to be absolutely clear and ride this wave. And it's very important to look at this theme from a medium to long term perspective. There are many new industries that have been created, even in a relatively high growth economy like India, where we have seen internet economy and businesses that have come out, be it food delivery, be it anything related to quick commerce, which is a huge industry and growing at a very fast pace, or for that matter, things like D2C, where newer and newer brands have been created from nothing in very few years and very less amount of time. So all of these, can be part of the innovation theme, and they are reflected, in fact, in our innovation fund if you see the portfolio.
All right, Ashish. So we've come to the last question of the interview.
Sure.
Uh, how do you hedge or position your portfolios when macro uncertainty is high, but equity inflows and domestic investor sentiments remain strong?
So, yes, I mean, it is absolutely clear that there is so much of opportunity and so much of growth potential across so many sectors that is there in our country. India still remains a growth economy, and there is so much that the demographic dividend and other things that we are seeing, where we are, sort of playing catch up with the world and probably leading the world in some of these sectors now, can result into good investment opportunities. So yes, I mean, staying invested in such type of businesses is what we are, focused on. But at the same time, to protect the portfolio, there are various strategies that one does adopt, especially funds which are related to asset allocation, especially funds which are much more cyclical in nature. We do take some level of hedging positions if needed, be it via futures, if needed. Also, if there is a unidirectional call that one needs to take via options. So, derivative is something that can help the portfolio manager to sort of tide through near-term uncertainties. And as we know, most of the liquidity in derivatives is probably 1 or 2 months positions. So that's where one can take near-term calls to hedge the portfolio. We are going to see more and more uncertainty in the next few months as we go through the global scenario, and to that extent, derivatives will be something that can be deployed to tide over these changes.
All right, with that, we've come to the end of this interview. Thank
So,
you so much, Ashish, for sharing these valuable insights with us and our audiences. Thank you so much.
thank you so much for having me. It was a pleasure and great questions from your side. Thank you.